Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. Brief look back to last week. Obviously, Powell's pivot, the use of the word transitory, and the chairman's words himself. Why use a word that's confusing markets when you're trying to portray policy here is very, very transparent? So out the door goes transitory. We've spoken and written about that over time now. But more importantly, with regard to the labor market, to get back to the kind of labor market we had before the pandemic, we're going to need a long expansion. We're going to need price stability. So the Fed needs time here. And when we look at last week's employment number, certainly the household surveys, labor force participation, employment to population ratios, all moving in the right direction. The demographics look solid. The unemployment rate, despite people coming back into the labor force, coming down. So the Fed needs to keep that moving forward. To keep that moving forward, the chairman is saying we need price stability. So that tension between the dual mandate of employment versus inflation, right now the Fed's number one priority is trying to get inflation under control, trying to bring these inflationary dynamics lower. What does it mean for the taper? We think the taper the faster taper here is all but baked in for December. The outlier would be a surprise if they change course. They have sent the market, we think, a very, very strong signal. Friday's number solidifies that. We get CPI later in the week, which is expected to run close to 7% in terms of the headline number, the core number, looking to run somewhere in the high fours, even close to 5%. So this certainly all keeps the Fed on course for a faster taper. And then with regard to the market, the yield curve, this notion of the Fed making a policy mistake. Certainly if you look at the forward curves in Eurodollar space, certain parts of those curves have actually inverted. If you look at the OIS curve, you look at those forward rates, certainly on Friday we had a little bit of inversion between the 3-year forward and 5-year forward. So yes, markets are concerned here. And we put out some content over the weekend on LinkedIn. Please feel free to follow us. When you look at it historically, if you go back and look at the funds rate, since 2000, the average Fed funds rate was 165. Since the global financial crisis, we've spent a lot of time close to the zero lower bound. So markets are very efficient here. But in the end, if you look at it more succinctly of recent, 125, 175, the 2021 range. We were at 170 November 24th when the news of Omicron hit. We've had Powell's pivot. And really the story of 2021, again, we had bearish positions toward the end of November. Now a very quick move down toward the bottom end of our range of 125. Wishing everyone a great week ahead. I'm Greg Faranello, head of U.S. rates for Amerivet Securities.